Today we're diving into a topic that every international investor needs to understand: currency fluctuations and how they impact your returns. If you invest in foreign stocks, ETFs, or bonds, then exchange rates play a role in your portfolio's performance, whether you realize it or not. Welcome to the channel. My name is Eric Silvaggi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington-Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. In this video, we'll cover what is currency fluctuations, how it affects investment returns, real-world examples, hedging strategies to manage currency risk, the value of hedging, and when you might not need it. What is currency fluctuation? Currency fluctuation refers to the constant changes in the exchange rate between different currencies. For example, $1 today might be worth $1.35 Canadian. Next month, it might be $1.30 Canadian or $1.40 Canadian. These changes can significantly impact foreign investments when converted back to your home currency. How currency fluctuations affect investment returns. When you invest internationally, your return depends on two factors: the performance of your investment, the stock, bond, or fund, and the exchange rate movement between the foreign currency and your home currency. If your home currency strengthens, your foreign investment may lose value when converted back. If your home currency weakens, your foreign investment may gain value when converted back. Even if your investments performs well, a strong home currency can reduce your returns. Examples of currency impact on returns. Let's say you're a Canadian investor buying US stocks. In scenario one, the Canadian dollar weakens. You buy 10,000 worth of US stocks at an exchange rate of $1.30 Canadian. Later, the stocks remain in the same price, but the exchange rate shifts to 135 Canadian to USD. When you sell and convert back to Canadian, your investment is now worth $10,385 Canadian, a gain of 3.85% just from the currency movement. Scenario 2, the Canadian dollar strengthens. You buy $10,000 worth of US stocks at 130 Canadian to USD. The stock gains 5%, but the exchange rate shifts to 125 Canadian to USD. When you sell, the currency move wipes out a part of your stock gain, reducing your profit. Bottom line, currency fluctuations can amplify or reduce your actual investment returns. How to manage currency risk. Since currency movements are unpredictable, investors use different strategies to manage this risk. Firstly, they use hedging strategies. Hedging helps protect your investments from currency fluctuations. Some ways to hedge will include currency hedged ETFs. These funds automatically hedge the currency risks for you. Forward contracts, which are agreements to lock in an exchange rate for the future. Options. These give you the right, but not the obligation, to exchange currency at a set price. Hedging can reduce volatility, but also limit potential gains if the foreign currency appreciates. Number 2, diversification. Having investments in multiple countries and currencies helps reduce reliance on one specific exchange rate movement. If one currency weakens, another investment in a different currency may offset the loss. 3, strategic asset allocation. Some portfolio managers hedge only a portion of their foreign holdings, like 50% hedged and 50% unhedged, to balance risks and potential returns. Should you hedge currency risk? The decision to hedge or not to hedge depends on your outlook on the currency. If you believe the foreign currency will appreciate, going unhedged could add an extra return. If you think the foreign currency will weaken, hedging protects your investments from losses. Your investment time horizon. Short-term investors may benefit from hedging since currencies fluctuate more in the short term. Long-term investors may not need hedging as currency fluctuations tend to even out over time. The cost of hedging. Hedging adds a cost, especially in less liquid currencies like emerging markets. US dollar hedging is cheap, but hedging for smaller currencies can be more expensive. The value of hedging. Hedging is often described as buying an insurance policy against currency fluctuations. When the Canadian dollar is rising, hedging protects investors from currency losses. When the Canadian dollar is falling, hedging reduces gains investors would have otherwise received. For example, in 2007, the S&P 500 index rose by 5.2% in US dollars. But for Canadian investors, after currency conversions, it actually lost 4.7 in Canadian terms. This is why it's crucial to understand how your investments handle currency risk. Let's go over some common questions about currency fluctuations and hedging. Should I always hedge my foreign investments? Not necessarily. Long-term investors may need hedging since currency fluctuations tend to balance out over time. Can currency movements create opportunities? Yes. A strong Canadian dollar means foreign investments become cheaper, letting you buy more assets at a discount. Do all ETFs hedge currency risk? No. Some ETFs are currency hedged while others are unhedged. Always check before investing. What happens if I invest in multiple currencies? If you hold a well-diversified portfolio, different currency movements can offset each other, reducing your overall risk. How should you approach currency risk? Understanding how currency impacts your investments, even if you're not actively trading currencies. Decide whether to hedge based on your goals and risk tolerance. Diversify across different currencies to reduce reliance on one single exchange rate. If you invest internationally, currency fluctuations will affect your returns. The key is knowing how to manage the risks and opportunities they create. If you found this video helpful, give it a like and subscribe for more investing insight. Have you experienced currency impacts on your investments? Let me know in the comments. Thanks for watching, and I'll see you in the next video.